All right, welcome to the section on wave counting. I think as a good way to begin it, I would like to review an example of how not to count waves. So if you'll take a look at this particular chart, you might be interested to know that this is a reproduction of a chart that actually appeared in a stock market publication. Now, you have only listened to 2 hours of instruction on how to count waves. There's a lot more to come, and yet I have a feeling that some people in this audience could point out some errors in this labeling. Anybody see anything wrong with this chart?
Wave 3 shortest.
That's a good point. Wave 3 is the shortest. Wave 1 is longer. Wave 5 is longer than that. That's not allowed. Any other problems with it? Yeah. We've got overlap here. This wave 4 goes deeply into wave 2 territory. This is meant to be 5 waves labeled A, B, C, D, E. And D overlaps wave A. Those aren't allowed either. So we've broken some rules here, not just guidelines, but rules. Does anybody see another problem? Well, there is a place where there's a 3-wave problem. You notice this 4? You might say that came into the previous 4th, but how could it when wave 3 doesn't even have 5 waves in it? This Roman numeral 3 has 3 waves in it, up, down, up. And that's not right. So we've got the wrong number of waves in an impulse. It's supposed to be 5 waves, and we've only got 3. We've got overlap from wave 4 and 1, and we've got a 3rd wave, which is the shortest in several instances. You now know enough not to make a single one of those mistakes. So don't do it. Charts such as this, labeled elsewhere, are often a gold mine of instruction on how not to count waves. Very often I'll hear from somebody, yeah, well, so-and-so's opinion is this, and this guy says he's bullish while you're bearish. Well, there's plenty of room within the wave principle for diversity of opinion. You can have different, legitimate interpretations of the wave structure. But most of the trouble comes from people who are not following the rules, much less paying attention to any of the guidelines. They're letting their opinions come first, their gut feel come first, and their analysis come second, and you cannot do that. So don't do it, and you'll stay out of trouble. All right? Well, we've learned how not to do it. Let's take a look at how to do it. The charts that we're going to examine now are of the cocoa futures market. Now this, for the most part, is a reprint of a page from the Elliott Wave Theorist, which was published November 29th, 1982. I'm choosing this particular wave pattern and commodity for several reasons. First of all, this was done already in real time. The bear market that we're going to analyze was analyzed once before in real time, and the bottom within 4 trading days was recognized, and it was published as such. So we're not going to look back at a chart and say, oh, look how neatly it reflects Elliott now. You can see everything now. We saw it then, and we're going to show you how it was done. However, there's some other interesting aspects here. Do you know that the cocoa market is often described with the adjective exotic? It has nothing to do with dancers. It has to do with the fact that cocoa is considered a weirdly acting commodity. Some people think it just doesn't act like most other commodities. It's also hard to categorize. It's one of the foods, but it's not a grain and so forth. So people consider it a bit unusual. A lot of Elliott Wave people might say, well, I'm going to stay away from this. One of the problems in dealing with commodity charts also is that you are not analyzing, most of the time, the price of the commodity. You're analyzing the price of a futures contract, which is a parasite on the commodity. And futures contracts have certain characteristics which make them a bit more volatile, such as incredible leverage. You're not out there buying 3 boatloads of cocoa with a broker. You are actually putting up a little bit of money and speculating on the trend and you are heavily leveraged. Therefore, many decisions are made not because you do or do not want to own cocoa. They are made because your back's against the wall and you're out of money in your account and you've got to get out of the trade. That tends to make the daily moves somewhat more volatile and perhaps cover more ground than they would if indeed people were truly trading the physical commodity back and forth. Also, you should know that the weekly charts, particularly, are what we call continuation charts, which means when one nearby contract expires, the people who keep the long-term data on the commodity futures merely tack on the next chart. Well, very often the next month's futures contract is trading at a different price. So you might see a jump in the price that essentially didn't really take place on the chart. That helps make difficult being certain that the waves you see actually happen because of real trading. And the last reason I chose this particular market to examine is that it is a market which is going down. It's a bear market. And rather than make it easy for us and pick a chart that we're visually comfortable with, a five-wave structure on the upside, I wanted to look very deeply at an ABC bear market decline, particularly the way wave C is subdivided. Well, let's first get a perspective on where the long-term wave structure was at the time. This is a monthly futures chart of cocoa. It begins in 1965 and goes all the way to 1982. Roughly speaking, it shows you a five-wave bull market. Again, we're dealing with futures contracts, and you probably notice, if you're very careful, that there was a slight overlap between 4 and 1. Well, again, in the price of the real commodity, I rather doubt that overlap occurred. Again, we have a little bit more in terms of stretching the prices in each direction because we're dealing with a leveraged futures contract. Roughly speaking, you can see that the five-wave pattern, the basic development is there. A first wave up, a second wave decline, which comes quite near the low and forms a base pattern for the really powerful move up in wave 3, a wave 4 decline, and the fifth wave to new highs. Remember that fifth waves in commodities tend to be the longest and most powerful of the three impulse waves, and this cocoa chart does show that, being a long-term bull market pattern. Now, one thing that's a bit unfortunate, in my opinion, is that commodity chart services issue charts on arithmetic scale. And it makes so much more sense to put them on semi-log scale, where you can see the percentage advances revealed, and usually channels that make more sense. In other words, the lines are more parallel. Unfortunately, long-term charts like this, which show bull markets on arithmetic scale, usually show apparently extreme movements in spike highs that are much more orderly on semi-log scale. Anyway, you can see that the five-wave pattern in all of its essential elements is there, and once the bull market is over, a bear market begins. Now, how many waves should the bear market unfold into? It shouldn't unfold into a 5 because corrections are never 5 waves. In this case, we're going to be looking for an ABC or 3-wave pattern. Ultimately, perhaps it will develop into one of the longer stretched out corrective patterns, which is a play on that 3-wave theme. But at the very least, we need 3 waves against the trend in order to say that the bear market is over or potentially over. Now, you also know from our discussion of guidelines where the bear market is likely to end. Somewhere in the span of the previous 4th wave. And that, of course, is in this area. And as I said earlier, the low usually occurs somewhere near the low of that preceding 4th wave, and of course that's somewhere in this area. So coming off of the high, regardless of when you finally determined that a major bear market was in force, regardless of when you decided that a 5-wave bull market had indeed taken place, you have a piece of knowledge that most people don't, and that is the ultimate likely extent of the decline, right in the area of the low of the previous fourth wave. Okay. Commodities usually begin with sharp reversals. Waves A are usually crashes from a high. And that certainly happened in cocoa. Once wave A was over, wave B occurred, and it was then required that a wave C carry to new lows. Now we're going to spend most of the time here analyzing the movement within wave C, assuming that somewhere during that wave, any Elliott wave analyst would have begun putting all the evidence together to try to make a decision as to when the major bear market was ending. So let's take a look at the weekly chart, which breaks down waves B and C into a little more detail. All right, I've labeled here the end of wave A, which presumably took 5 waves to unfold on the downside. Remember, wave A is now moving in the direction of the one larger trend, which is down, and therefore it subdivides into 5 waves. Wave B is the counter trend movement. Therefore, even though it's heading upward, it is going against the larger trend, and therefore is going to subdivide not into 5 waves, but into 3. And if you look at that chart, that's exactly what happens. There's an upward movement for a smaller A, B, C, to complete wave B. There are a lot of alternatives as to whether or not wave B actually is ending at exactly this point in real time. There's probably a good argument to be made, but there are other corrective patterns. So someone could have reserved the right to say, well, I may change my mind later and say that wave B is probably still in progress. But since you have completed a reasonable corrective pattern, it's time to be on the lookout for the start of wave C. All right, now, if wave B is over and wave C is now in force, how many waves should we see in the subdivision of wave C? The answer is 5. It's going in the direction of the one larger trend, which is down in a major bear market. So we need to count a full 5 waves downward in wave C to determine that the bear market is over. Let's see if we can do that. The first decline from the B wave high subdivides into a down, a rally, a down, a rally, and a final decline. In other words, 5 waves down. 1, 2, 3, 4, 5. That was a very strong indication that wave C indeed had begun. Because now you see you're getting 5 wave developments on the downside again, suggesting that the one larger trend, which in this case is wave C, is pointing down. And of course, you're going to turn out right on that one. Now, once wave 1 is over, what do you know? It's time for some kind of counter-trend pattern. In this case, it'll be a rally. And we do get a bit of a rally right here. It could actually have ended there. After all, it subdivides into 3 waves, comes right back in the area of the previous fourth. However, in this particular case, the development fell to a new low in 3 waves, which indicated that this decline was counter-trend, and then moved up here into a peak of wave C. In other words, this circle 2 upward corrective pattern was a complex sideways correction. Why? Because prices actually entered a territory below wave 1. So now you can say with certainty that wave 2 was a sideways style correction. This is important because when we get to wave 4, you're going to want to apply alternation to decide what shape wave 4 will be. Notice that wave 2, the upward corrective pattern, ends right in the area of the 4th wave of the preceding impulse wave of the same degree. You knew that before wave 2 started, that that area was the most likely area for the rally to terminate. if wave C indeed was in force. All right, once wave 2 is over, you're going to have wave 3 as a natural next development. Now, this commodity price is now heading downward, not up. So fear is not the driving force. Therefore, fifth wave is not likely to be the longest. The third wave is. And we're back to the typical development of wave 3 usually being the longest wave. And sure enough, wave 1, 2 subdivides, a long third within the third, which is again normal. Wave 4 and wave 5, a long 5-wave subdivision creates circle wave 3. Now, you're starting to get interested in this commodity as one that may be reaching a long-term bottom. You've had wave A down, wave B up, and 3 waves within C. What is left to occur? A rally for wave 4, and then a final 5th wave down. What are your expectations with regard to this? Well, the wave 4 rally is a counter-trend move, so it's likely to peak somewhere in the previous 4th wave area. Wave 5 usually carries prices to a new low, so you would expect when wave 5 comes up that you will take out this low for wave 3. And what have you known all along about where the ultimate bottom is likely to take place? It's probably going to occur somewhere near the low of that previous 4th wave, way back here somewhere, which, as we already saw, is in this area. You know a lot about this commodity. Let's follow it through and see what happens. Here comes a terrifically sharp rally at the end of the 3rd wave, and you already know several things about how that rally is likely to unfold. Number 1, it should peak near the area of the previous 4th wave. In this case, it actually exceeded it by a slight amount. What do you know about the extent of wave 4? What is it virtually not allowed to do, except in a future situation, perhaps by a few pennies? It can't go into the territory of wave 1. So there's no way it could have gone higher than this level. Once you got in this area and count A, B, C up, it's time to assume that wave 4 is over. Is it likely that wave 4 will then have further development? Is it likely that wave 4 is going to come down here and make a new low and then rally back up and get complex and be sideways? The answer is no, because you've already had one. And by alternation, since you've had one complex sideways correction, wave 4 is likely to be simple. Over rather quickly, very sharp against the trend, and not make a new low within it. All right, and that's exactly what happens once you count an ABC rally right up to where circle 4 is here. Now, what are you looking for? You're looking for the 5th wave down. How many waves should it subdivide into? 5, because it's going in the direction of the one larger trend. It's likely to make a new low below wave 3, and it's likely to stop somewhere probably higher than that area of the previous 4th wave. Your knowledge is increasing as the bear market is progressing. All right, let's look how prices actually moved. Right off the top of wave 4, you had a decline, a rally, a decline, a rally, and a decline. A very pretty 5-wave structure down to complete intermediate wave 1, this little 1 in parentheses. Notice if you look closely at that the internal subdivision is a very nice 5-wave structure, even on this weekly chart. Then comes wave 2, which is an ABC, does not carry to a new high. Wave 3 unfolds. Can you see the subdivisions in this one? Down, up, down, up, down. A beautiful 5-wave subdivision within wave 3. Notice that wave 3 is longer than wave 1. So already you can now begin to apply another guideline. The 5th wave down, intermediate wave 5 in parentheses, will probably be approximately the same size as the 1st. That's the idea of equality between waves 5 and 1 when 3 is the longest. All right, once wave 1, 2, 3 intermediate are over, it's time for a 4th wave. Wave 4 gets underway. Notice that it peaks exactly in the zone of the preceding 4th wave. That's the low of the 3rd subdivision, and this is the 4th. Already having told you where the likely resistance level would be. And now